Okay, folks, we are going to be covering a principle of trading that hasn't been really touched on uh, since the module how professional traders use indicators. Because now we're going to go into the realm of the market where a lot of pure price action traders will kind of like scoff or probably sneer their nose up at this. But I assure you there is some useful insight to be gleaned from it. And I'm giving this module to those that have a difficulty in determining directional bias for the day, or have struggling with market flow and market structure. Should they be buying or selling? I think this one's going to be a lot of help for those traders that have been following for many months, over a year now. If you've been struggling with directional bias, this is the one that's going to really nail it down for you. Okay, so let's pick. Let's look at the. Well, we can use the Australian. We'll look at two pairs. We'll use one of my favorite pairs, the cable, and we'll look at the Australian dollar just to show it does work on other currency pairs. All right, what I'm going to do is I'm going to pull up a daily chart, and what we're going to do is we're going to plot two moving averages. Okay, and the first one's going to be a 40 period. Okay, 40 period exponential on the close, and whatever color you like. I like red. Okay, and we're going to plot another moving average. Okay, this one is going to be an 18 period exponential on the close, and let's use let's go with blue. You guys can use whatever color you like, but I'm using these for this example. The averages, all right, the way I use these is simply, I don't look for the crossover. I could care less about the crossovers. The crossovers do not signal anything until we have price structure on our side. Okay, and I'll go over that in a moment, what that means. But just for overview sake, you can see how if you are looking for periods when the 18 period exponential moving average on the daily chart is above, okay, and opening, okay, here's the most important part is the moving average, the blue one in here, and I'll zoom in a moment. I just want to give you a wide perspective. If it's above the 40, okay, very simple rules. If the 18 period exponential moving average daily basis is greater than the 40 period exponential moving average daily basis, okay, you want to be looking for buy signals. If the 18 period is below the 40, it's very simple. You're looking for sell signals, okay? Now, you can see how that keeps you, on the most part, on the right side of the market, okay? It allows you to participate in the profit release portion of the trending markets, okay? And the time it gets you in trouble is when you reach significant highs or lows, and we have concepts to keep us from getting too beat up and hopefully profit in those conditions. It gets back to the market profiles. Are we in a trending market? Are we in a swing, down in an uptrend market? If so, we want to be doing some short-term swings to the downside, but not getting married to the vein, and really being cognizant that this may be just a pullback in a longer-term uptrend. Okay, so vice versa, all those things. I'm not going to repeat the market profile module here, but if you're a little unclear what I'm talking about, go back to that one, and you'll see greater examples and insights about that. All right, so I'm just going to zoom in, okay, and since happens to be on the chart right now, this is a consolidation or range bound market profile, okay. So even though that 18 period may be above the 40, okay, or the 18 period may be below the 40 here, doesn't necessarily mean that you're going to be trading just simply on that. All right, uh, you would be looking for a totally different trading approach when we're in a range. All right, so I had to toss that in there simply because it's right there on the chart. Periods when, and this will be an example, when the 18 period is above the 40, and I think we can clearly see that's the case here. Okay, this concept is not going to give you the low and getting out at the high, and that's not what you need. You don't need that to make money. You want to have a concept where you're working a regular 9 to 5 job, and you want to be able to trade off your smartphone and use alerts to be able to do that. This is one way of doing it. Okay, so you don't have to be in there day trading and trying to capture every little move. Also, I've already shown that if you just get 25 pips a week, risking 2%, and allowing for compounding, your account, regardless of what balance it is, will more than double in a year. Okay, if you are new to trading, okay, with no technical analysis background or speculative experience, my advice would be to risk 1% and aim for 50 pips over the week, and you still accomplish 100% for the year. And 50 pips, I assure you, is absolutely doable even for a neophyte. So don't let that be a discouragement. And if that's not something you believe, you'll believe it after this module. All right, in the thread on babypips.com that I hosted for well over a year now, what every new and or aspiring forex trader still wants to know. If you haven't viewed that thread, it would be my advice to go and visit that thread. At the end of this video, if you just discovered me on YouTube or someone else that's been syndicating my videos on another forum or whatever, my real home is on babypips.com. So that's where I share my material. I don't post it anywhere else. So looking at periods when we have the condition met where the 18 period is above the 40 and it's opening up, okay, it means there's a separation between the two and it's widening. Okay, when you see that, that is your green light go to be on a buy program. It doesn't mean you won't have profitable sell days. It just means that you want to be focusing on the buy setups. Okay, so now how do we get into a setup based on the stage or premise that this is built in for us? Well, you bring in your little fractal indicator, okay, and I'm just going to set it to pale golden rod. That's the color I like, and you can use whatever color you like. Once the condition is met, okay, and we have that here and it's opening up, if we have price, let's go back to what it would look like on your chart. Okay, once price makes a fractal or swing low, very important. Now we've included market structure, okay, and swing point analysis and market flow, okay, because market flow would have changed to bullish here. Okay, you have a swing highs broken to the upside. Okay, we have a new swing low. So once this low, if it does ever get taken out to the downside, that would move market flow back down or bearish. But since we have used the moving averages to give us a trading bias, okay, for directional bias for our trades, we want to wait for market structure to get in sync with that. We just simply don't be going into the market looking for buy signals just based on moving averages. Are they stacking or are they opening up to the downside? That's not important by itself. Remember, the concepts I'm sharing individually, they're useless. But when we have a combination of ingredients, then we get blue ribbon results. So we have the low here. you have a higher low and a second higher low. Okay. On the power of 3 module, we learned that typically when we see this formation, okay, a fractal low or swing low, and we are in a bullish environment, the way we trade it is we look for the open after the fractal is formed. Now, granted, I'm a little bit more aggressive. I'll trade the very next day. So I would have traded long on this day here. And this is the day. Let me scroll over more. This is the day you would have actually taken the trade. You would have been looking to get long. And the way you do it is you simply wait for the new day to start in Asia. Okay, plot your pivot points, plot your support and resistance levels, previous day's high and low, Fibonacci, and you'd simply look for buying opportunities once price tries to trade down from the opening price. Okay, so find the opening price on this day and you wait for a move down. You can catch SMT divergence, all of your indicators, as we've learned on how professionals use indicators module. You could use oversold and bullish divergence on stochastic, MACD, RSI, whatever oscillator you like to use. This is when those indicators will work for you. Okay, because now you have market structure in sync, you have market flow, you have short-term oversold conditions with a directional bias that's underway. Okay, and you can see how the market had traded up here and even went a little bit higher and then gave back a little bit of profit the following day. Okay, we had the same situation here. 18 is above the 40, so the stage is still bullish. We're still in a buy program. We have a new swing low. Now, you would need this bar here to classify or form the swing low fractal on your chart. Again, I would be trading on this day here simply because I used a 3-day pattern. I'm not suggesting you do that if you're new. Okay, but this is the day that you would have been trading using the fractal. Okay, here's the open. Okay, and we have an up move and closing near the high. Okay, price trades back down, gives you another fractal, and it would form on your daily chart with this day here, because you have to have 2 higher lows and 2 higher lows on either side of a low to make a swing low. That's based on this indicator. To me, I'll trade anything with a 3-day pattern. If I have a higher low yesterday, if I have a higher low 2 days ago and a lower low yesterday, I'll trade anything that may be a Judas swing going lower to get long. Especially if I'm in a pivot zone buy, and if I'm finding support like in a Trinity matrix zone or anything in that region would set up a buy bias for the day, sentiment wise. I'd be in here looking for S&P divergence, optimal trade entries, to get long. But here, because I'm teaching the neophyte, directional bias, okay, you wait for the fractal to form. This day it forms on your chart. The next day you look for the open, get the opening price, look for a move down away from the opening price. Okay, as soon as Asia's trading, find that opening price, note it on your chart, wait for a swing away from the opening, going down. It may not be very many pips. It could be as little as 15, 20 pips, but that's all you need. You want to see that move down away from it, okay? And then what will happen is it'll create a low, and then it'll trade higher. And that's the case here. You have the open, trades down, makes a low, and then trades up. On this day alone, this day here, the low came in at 105.10 and the high came in at 105.77. Okay, so 67 pips potential, and that's the Australian USD pair. I don't do a whole lot of trading in this pair, but you can still see the method still works. And price gives you another swing low here, and it would form on this day. Now, this one moved a considerable amount of pips. All right. If you are looking to capture um, good chunks of pips, the way you do it is holding on to a certain portion of your trade and taking a good chunk off, 70% off at your target, whichever that would be for your intraday, and then let the remaining portion of it run. And let's look at the examples that we've had talked about so far just in this buy program using this method. Okay, the first fractal here, getting long on this day here. This day alone, the high was 103.96, low 103.14. Okay, so 82 pips potential range to make profit from. I'm not saying you're going to get all that, but if you get 30, 40 pips of that, that's still healthy. And I think that's a fair amount to say that, using this method you could do that. And take your profits. Now, if you were going to trail a stop and try to catch a short-term trade, you could leave the stop below this low. Okay, now granted, you made a little bit more money here, and eventually it would have stopped you out. It would have took out that low. Okay, so that's why you have to take some profits off. Wait for another price formation to give you a swing low to get long. Okay, you're going to get long on this day here. What happens? You have price run up in your favor. You can take your profits off, 70% off in the day that you actually trade, and then leave a little bit on, 30%, let it run, and eventually price would have taken you out, especially this low down here, getting you out at the day that you actually got into the trade. One more entry here. All right, you have a fractal low, and you buy, and your stop below here, take 70% off, comes down, and you would have been taken out of the market as well here. Okay, now that's how you would keep risk tight and just taking small chunks out of the market. Okay, as a intraday or short-term trader. As a short-term trader on a higher time frame, okay, what you'll do is when you have the swing low form, okay, you leave your stop below this, okay, by 10, 15 pips, okay, and then you wait for a new fractal to form, swing low, while you're in this buy program. Okay, when this fractal low forms and it trades higher, okay, this here, once you take out profit, take 70% off, okay, wait for this fractal to form, your stop would remain down here. When this fractal low forms and trades higher, okay, your stop loss still remains down here. I know probably you're thinking, wait a minute, why ain't I protecting any of these unrealized gains? Well, because you already took 70% off. You've already paid yourself. So you can let this one go and watch other pairs for other opportunities. If this is exactly what we're hoping it is for short-term, higher-term trading, we want to be in this thing for a couple days. We don't want to be just getting out today. Okay, we're not day trading. This is not a day trading concept. Now, you're using day trading entry techniques and concepts to get in the market, but you're using it to get in to try to capture a few hundred pips. You don't want 60 pips and be happy with that. Not if you're going to be using this method. You're going to be using it to capture a couple hundred pips, and you want to do it inside of a week or so. So your position right here, this stop would stay underneath this low until we get a second fractal low, which is up here. Then once you see this, the stop would move from here to 10 pips below this one. Okay, and then when this fractal low forms and price trades up, okay, and then trades a new fractal low and trades higher and breaks the fractal or swing high that was prior to this swing low, then you make your stop from here, it moves up to here. That's how you trail your stop loss on higher time frame short-term trading. Now hopefully you guys can see, and should be grinning, that this could very easily become a long-term position trade, and that's exactly what my short-term higher time frame trades are geared for. I don't just limit them to getting a couple pips inside of one day and letting it suffice. We all see it in the books. We hear it from mentors and authors. They say, cut your losses short and let your profits run. And I always bother me. I'm like, well, what does that mean? I mean, it sounds rather simple, okay? But really, what does it mean? Well, this is my definition and solution to that question, and it may not be suitable for you. It may not be something that you like, or it may not be exciting or sexy to you, but it's profitable. I'll leave it with that. So when this swing low forms, okay, you could have had a position here that you've managed all along in here, okay, and then you would have been able to capture this range expansion going up, okay. So if you just nickel dime it like this, sure, you can do short-term intraday, short-term trading. Yes, you can get in a day or two and get out, a day or two and get out, a day or two and get out. But my mindset that I'm trying to convey to you is, if you see this condition unfold, you have to leave a little bit on there. And let's assume for a moment you got in on the the uh, the low here, okay, based on this low, and you're trading on this day. All right, that's a pretty significant swing in terms of stop. So how much are you risking on these trades? You're not risking 2%. Okay, your risk is going to drop down, and I'll leave that up to you based on risk management. But you don't want to be risking 2% on these, because the range is being considered for your stop and your initial risk. Okay, so um, now if you're going to use this technique with the intraday technique with the Judas, then obviously your risk drops off precipitously, and then you can go back into the normal 1%, 1.5%, or at the very most 2% risk on your trades. Okay, but you have to take into consideration that this event may happen and it pulls back and may stop you out. Okay, so that's why you take 70% off. And if you can just get 70% off each time and get stopped out at even after that 70%, it adds up just as well as anything else. So I'm giving you some different perspectives. I'm not trying to give you a cast in stone, this is how you do it every single time, because honestly, that's the other thing. It's an irk to me. It drives me crazy. It gets on my skin when traders that teach say this is the only way to do it, or this is exactly how to do it, and don't do it any other way. Because that very condition that they use to get in their trade, that may not materialize as often as the system buyer or student may be walking into it hoping it would. In other words, what I'm saying is, there is a less frequency in terms of the setup unfolding, and you're going to lose interest and you'll walk away from it. You'll never trade it. Me, to be fair and be realistic, really, that's why I have several concepts, because I'm flexible. I know that the market's not going to give me the exact setup that I'm looking for every single day. It's not going to give me the classic buy London Open setup every day. It's not going to do that. It may do it 5 or 6 times a whole month, but that's okay, because if I get 3 out of those 6, I'm paid. I'm padded out for the month. I don't need to do anything else. Look at the ranges you're capturing, the whole daily range. So it kind of gets back to, what are you trading? Why are you trading? What are you trying to do? So hopefully you understand that if you're going to be trading different styles, you can do a higher time frame swing trading, and if you manage your trade properly, you can capitalize when we get these extrapolated range expansions. And let's move out a little bit further and see what actually unfolded. Okay, another swing high, so the trailing stop would be moved up below this one here. And the problem with this condition is you'd have to be willing to at least see maybe a retest of this high as support. And with the opening of the averages, it would really favor that. I would expect it, let's say that. But we have a further surge higher in price, and we're talking about over 500 pips. And using this method, it's very simple, very easy way of doing it. But let's assume that you, and I'm going to be fair, let's assume for a moment you took 70% off, and then you let the market stop you out on the remaining portion. Okay, you could have caught another opportunity to get long using the same system, because you have the 18 above the 40, so your buy program is in effect still. You have a fractal low, swing low, and it would form on this day here, and you look for a move from the opening down to get long, and then here's your move up, and eventually we get some topping in here. Now, when you have this condition, it's safe to look at continuation patterns. Okay, and that gets back to the market profile module where if you're going to be looking for continuation patterns, you don't look for continuation patterns in this situation here. That's consolidation and range. You don't look for bull flags in there. Okay, you don't look for that. You look for bull flags and ascending triangles and coils and triangles of continuation up patterns. Okay, in other words, you want to see patterns that indicate the likelihood of price continuing higher. And we have a bull flag here. We have an ascending triangle in here. If you didn't see that, it might look like a coil in here. But what I also want to indicate to you is whenever you see the 18 above the 40, okay, the reason why I tell you to use your trailing stop below the fractal lows. Also, note now the 18 period acts as a dynamic support and resistance. Support and resistance level. Also note that when price trades back down to that 18 period, okay, many times you'll see the ICT Holy Grail. I know you're probably saying, what? Yeah, I have a pattern. I dubbed the Holy Grail, and it's simply a trading pattern that allows for optimal trade entry and the type 2 divergence, or it's commonly referred to as hidden divergence. Everybody understands what the standard bullish and bearish divergence is in oscillators, where if we make higher highs in price, there is a lower reading in the oscillator when it's overbought. That would be a bearish, classic bearish divergence. And vice versa, if price is making lower lows, the oscillator goes into oversold and makes a higher low. That's a bullish divergence, and then everybody expects price to go up. It doesn't always work like that. Okay. Well, the reverse or hidden divergence would be if price is moving higher, as we have here. We have a low, and then price trades down, makes another low, but the low here is higher than this low. If you look at an hourly chart, you'll see that hidden divergence form when this condition is there. Okay, and then that's trend following in nature. You get in and you buy it, and then that's when you get the extrapolated move. So you'll get more insight on that in the how to trade and find explosive profits in the Forex market module. So, and I'm sure probably some of you already skipped to that one. So looking at the price action in here, I'm kind of revealing a whole lot to you, but the 18 period acts as a dynamic support and resistance level, and you can trail stop losses below fractals and below the 18 period moving average, and that'll keep you in the trade as long as it's in a trending environment. Okay, that is an example of the Australian dollar, and in a buy program, you can see how we traded up and down to the 40, back up, optimal trade entry, and then into consolidation, and eventually moving up to take out the stops. So that's how you can use the short-term trading concept, and this is simply using an 18 period and 40 period daily moving average. Crossover, no. Angle and separation for the averages is very crucial to it. Okay, it'll keep you on the right side of the market. If you are in here trying to trade with it, okay, if you wait for fractal highs and lows using the concepts we learned in the Power 3 module, you can still trade and find profitable trades. For instance, you have the average above the 40, and I'm not saying to use this here, but I'm just saying that the principle by itself of using fractal swing highs and lows and then expecting price to have a Judas swing based on that higher low is very, very strong. I mean, to me, that's the holy grail for intraday day trading. I mean, if you understand that concept, you could turn this computer off and never do anything else except for that and make as much money you'd ever want, just managing your risk and just trading that one pattern. You're going to have losses. You're going to lose money. But to me, when I learned that, it was like, wow, I don't need to be in here all the time, because how many times are you going to see a fractal form? Well, look how many. It's a daily chart. Look how many times they formed. Okay, you guys want to know what you're waiting for? You hear me preach all the time: patience, patience, patience. Well, what are you waiting for? Well, you're waiting for this is one. Okay, or whatever pattern you've grown to, whatever pattern that you've grown to like or trust that I've shared thus far. Here's an example. Um, Here's a fractal low. Price is still, even though price has slipped, even though price is even though price has slipped down, and the average of the 18 period is now coming down. That to me is an indication that we're probably going to consolidate. Okay, and we did that obviously, but if we get a fractal or swing low, that's still probably going to give you enough static push higher in volatility to try to reach for higher prices even on the short term. And let's test that theory. Here is the low. You wouldn't see it until 1 2 this day here. Okay, and here is the day where you would open, look for a move down, and it went down to the 40, and then but we had a range of, on this day, from low was 106.09 and high was 107.10. But I don't know if it made the move up or down prior to the close. So that may be a day that it may be unprofitable. I don't know. I'm not going to look at it because that's not the point here. But you want to be using the averages to get yourself in sync with the market structure and trend, and help you kind of like give you that little vote of confidence, saying, okay, look, I'm looking at fractals being broken on the high side. Market flow may be up. I'm not really sure. Let me see what the averages are indicating, and you can see that clearly this is we're in a nice trending move up. Momentum's higher. The banks, institutions are really putting it together, making it go higher. So that's when you want to be looking for buy signals. Just get in there, draw your line on your Asian range, get the opening price, look for a move down away from the opening price. That's your fake out, Judas. Everybody's going to be more or less shorting into that. And that's when you, as smart money, buy into it and you accumulate your position, go long, and hold on to it. All right, let's look at an opportunity where we have the sell side. Okay, we have market flow broken here to the downside. Okay, because this short-term swing low was broken here. Okay, so now structure price-wise, we would be looking for the averages to open up and give us a sell program. That happens on this day here. We have nice separation between the two. We have a fractal high, short-term high. Okay, so now 2 days after that, which would be 1, 2, this is when your fractal would form. Now I would have traded this day, but you, as following this method, you would wait for the very next day. Okay, and you'd be looking for price to do what? Trade from the open higher, give you a Judas move, and hopefully trade down lower. This day, using this method, you may have lost money here, or if you had been looking for the optimal trade entry or something of that nature, it maybe hopefully would have been kept from taking a loss. But let's be realistic. Let's say you took a loss this day. Okay, that's fine, no problem. Scratch it up as a loss. Don't overtrade. Don't freak out. Think you got to get it back that day. Okay, don't say, well, I lost $50. Let me get in there and try to double up and make $100 back, and I needed to make it back today. Stop. Okay, what are you going to do the next day? The same thing. You're going to look for the open, draw a line at your opening price in Asia's range, wait for a move out of Asia up into maybe the London Open. It may happen in Asia. Okay, you want to see it rally up. That's the Judas. You want to sell into that. That's where the smart money is going to be accumulating short positions. They're going to sell it to the public. The street money is going to think, okay, well, we made a swing low here. Okay, and maybe it went down and stopped it out. That's fine, but they're going to be trying to buy, because look what happened. They have a low here, higher low here, higher low here. So they're going to think maybe this is the low. Okay, because if you look at this low here, to this high, it pulled back. That could be viewed as what? That could be an optimal trade entry. Well, no, not if you're looking at it the right way. Okay, market structure is broken down. Okay, we've come off this high here. We're really reaching down off of an optimal trade entry that's formed here. Okay, and you have another optimal trade entry here. Okay, so now we got ourselves in sync with market structure and flow using this simple institutional concept. This is what the institutions do. You want to know how funds trade? I'm showing you exactly what they do. It's very simple. They just use two uh, daily averages to give themselves a trend indication, see where large flows are moving in and out of the market. And now we have the structure in place. We maybe have lost money here, or maybe we didn't. I don't know, but we're going to be fair and say we lost money. Say we lost our full 2% here. No problem. If you risk 2% on 30 pips, no problem. Take the loss. Lick your wounds. Maybe try to get in New York, okay? Or maybe even do the London close setup, okay? And if you notice that the high to the close, there may have been a London close counter trend trade. Notice how we took out the previous day's high. So I'm certain there was absolutely something in here to get bearish. You may have lost money looking for the initial move from the Judas. Maybe it didn't, or maybe it did give it to you. I don't know. I'm not going to open up the bar and look at it, but you can look at it for your own sake on September 20th of 2011. But we have the next day, the open. It makes a move a little bit above the open, and then what happens? They slam it down and then close on the low. Okay. On this day here, the high is 102.91. The low is 126. That's huge. That's well over 200 and some pips. It's massive. Okay. You want to catch these ridiculous big moves? I'm showing you how to do it, guys. This is exactly how it's done. So what do you do the very next day? Okay. Well, if you're looking at price trading here and you're in a down sell program like we have here, market structure is bearish, everything's down here. Let's scroll over, and this is what you would see on your chart. Price is trading here. All right. It's going to look for this low, and it finds it this very next day. Here's the opening. It trades up a little bit, gives you a Judas, and they slam it down again. This day, okay, the high 1.0072 and then the low is 0.9690. So I'm not sure if that excites you, but that's juicy. I don't know what you look for in terms of pip magnitudes, but that's massive. Okay, price trades down even lower, okay, and then pulls back up. We have still nice angle and separation on the averages, okay. Price is going to trade back up into that that low and act as resistance, but you can't expect it to stop on a dime. Got to give it some leeway, some push through, okay. We're not going to trade through that using this concept. We're going to wait for what to form? The next short-term swing high or fractal. Okay, so here you have it. It forms here. You see it on this day here. The very next day is here. You want to see the opening price, a false move above the opening price, a rally, a suspect rally, sell into that, and then you end up closing on the low. Okay, and that's a Friday. And then the next day, here's Sunday, and then if you carried it through the weekend, Monday's trading trades it even lower, and it's sickening if you see how much money is laying on the table for you guys. Then you use your objectives down here. Now, when you get in sync with this, and I'm going to toss this out there with you, you've seen this on the other modules, but if you look for your targets, okay, here's the 162. So if you're getting short up here, and you can manage your position, your short-term trades, okay, look what you're getting. Let's talk about that. Let's assume for a moment you got a crummy, real crummy fill. Say you got here on this bar here. Say you got down here below the opening. Okay, say you missed it, you slept over, you got in here, and you don't get the low down here at the 162 extension on limit. Say you goofed that up too. Say you got in the middle of the range down here. That's 648 pips. Okay, 648 pips. Who doesn't want that? Man, I've been trading for years. Give me 600 pips. Give it to me. You'll I'll tip you for it. Thank you. Okay. Look at your charts, guys. Okay. You do not need to be trading 25 times in the same day. You don't need to be doing 25 times in a week. If I have not done anything except for to broaden your perspective, I'm saying, okay, if I focus on the higher time frames, can I make money with this and not have to do all this trading, clicking and clicking and clicking? I'm going to try to make my 2% today. Look, man, that's not how you survive in this business. You need these types of moves to pay for your goof ups. You're going to screw up, man. I screw up. I still sometimes when I'm half asleep and I'm trading London, I have still to this day still made mistakes where I go in and I'll click a buy order. And I'm being honest with you, I'm clicking a buy order when I actually meant to sell. And I'll put the order in, okay, and I'm looking at it, and finally it'll registering. Oh, I'm on the wrong side of the market, but the move's unfolding for me, but I'm in the wrong side. So I'm being real with you, okay. You're going to make mistakes. Now you may not make that mistake ever, and you may have a perfect streak where you don't make a mistake with order entry. But I'm telling you, as a real human being, I've done that, and I've done it a lot. And I'm not embarrassed to say I'm I'm telling you, this is stuff that just people do it sometimes. I just can't stress it enough. Don't expect, because I've been doing this for a very long time. Don't expect me to be perfect. I'm not. I lose money. I still screw up. Put my orders in. Um, Sometimes I don't get my fill because I'm looking for the actual sweet spot, and that stuff's going to happen to you. And if you get in there and you get ticked off that you missed a move or you lost, and you get emotional and you start pounding the screen because you lost, well, number one, it's indicating you've got too much on the trade. Two, you're greedy, and you're fearful that you're not going to find another trade set up. Look how many times these things set up. Okay, it's not every day. It's not every day that the short-term patterns set up. But if you wait for it to set up, okay, it gives you a huge, absolutely huge advantage over the standard retail trader because they're looking at 5-minute charts and what's going to happen in the next 20 minutes. Painting in the next 20 minutes, I want to get out. If you're thinking like that, you're really absolutely selling yourself short. And you're not going to, I'm telling you right now, you're not going to last in this business. I guarantee you will not last in this business because you have a myopic view of what you think the market should do for you versus what is the market doing, and hopefully how can I get in sync with what it's trying to do. That's how you profit. The banks are selling this thing lower. They're sending it down. They're repricing lower. All the buying in the world you're doing isn't going to make it go higher. It's not. They have it set up. They've engineered the rally here, and they've sent it lower. So all your short-term trading needs to be in sync with that. And if you do that, you absolutely can make hand over fist money, money, money. Okay. Now, as a day trader, which we're not going to cover in here, there's still opportunities to get in here and start buying. Here's a nice profitable update here. Here's profitable updates in here. But if you want to really see where the money's being made, look at the down days. Okay, that's where the huge, big range expansions are happening, and that's how you catch a lot of forgiveness for poor order placement. Okay, looking at the cable, let's take the grid off and put a daily up real quick, and we will plot our moving averages. 18, 40. In case you're wondering, why am I using the 18 and 40? All right, I've been trading for a very long time. I've met a lot of institutional traders and some of the larger bank traders that I've met and have relationships with. Let's just call it that. They reveal some of their trading models with me, and while they don't go over all their algorithms, um, one of the simplest forms of directional filters they use is just simply this one here, and it holds up very well when you understand what you're doing with it. If you're just looking for the crossover, that's what's going to hurt you. Okay, that's what's going to be painful, because you're going to be expecting it to act like a stochastics and soon to cross over. And there's going to be many times it does that, but it's lagging. It's so lagging, and that's where the power of it is. Okay, um, I'll just go over just one example here, and then we'll close this up. I think we pretty much beat this one to death. The fractals, plot them on there. All right, and let's zoom in. Okay. All right, we will use this one here because we have market flow and market structure broken. We got down here, and then we have the swing high or fractal high. All right, so here, 1, 2, this is when your fractal would form on this candle, creating this pattern for your MT4 platform. Okay, I would have actually been selling on this day here, but here's the day that you actually trade on using the fractal. Here's the open, trades up, gives you a Judas, down, and then you place your stop loss and manage your position accordingly, and hopefully get yourself some pips. Now, if you would have got in this move here, looking for it to give you a short-term trade moving lower, we could use this low to this high. Here's your 200 extension. Okay, so that would have been a reasonable expectation for price to get to. It sliced through that like a knife through butter. Let's see if there's anything over there except for, no, it's open, dead space. I'm not going to go back farther, but you can see how using this swing was pretty much nothing there, but we'll probably find the 127 extension using this swing, or 162 here. Okay, so getting in a short-term trade, letting it ride down, it's very profitable. And you're looking at swing of, let's say you got a horrible fill and you got down here, and I'm trying to be as fair as I possibly can, and you only got out at the 200 extension. Let's be reasonable. Okay, that's 450 pips roughly, 450 pips on a short-term trade. Okay, and it didn't take very long to get that. Now, if you are astute and you understand swing analysis, and that's learned by following all the thread material that we've been releasing, all the modules and the swing trading module, you understand that you could see this price swing unfold once this low is taken out. You want to be reaching for your extensions, and 127 down here, and obviously 162 to the pip, nailed it. Let's see what we've possibly pulled in as a pip haul for that. Again, poor placement, take that in consideration. Let's say we just got the 127 extension. There's 630 pips. Okay, 630 pips. 600 pips, not 25. Okay, not 10 every 10 minutes. This is one trade, put it on, and go to work. Read books in the evening, relax, read the forums, let your trade move. Okay, that's huge, guys. That's huge, and you're not doing a whole lot of trading. Okay, that's a short-term trade. Let's look at a buy. A buy. All right, we have nice angle and separation in here. Market flow is bullish. We've taken out this high and this high. Okay, and we have support at the 40 period daily not SMT, listen to me, 40 period exponential moving average. Okay, and price trades down to the 18 period as well. Looking for a Judas swing, open, false move down. It took out previous days or weeks, Friday's low in here. Get long, boom, take off. And on this one day, the range is 158.21 to high of 160.48. Huge, over 220 pips possible for that day alone. The next day, Okay, price continues even trading higher. Okay, even higher the next day, and even higher the following day. Okay, using the extensions, here's your swing, this low to high. Okay, here's your 1618 extension right in here, and that essentially takes out these highs over here, and that would be a very nice objective for your short-term trade. And in terms of pips, that translates to, let's give it a worst case scenario, you'd say you got poor fill and you're just getting out at the 1618 extension. That's 400 pips. Okay, 400 pips inside of 1, 2, 3, 4 days. Who doesn't want that? Who doesn't want that? I want it. So that's how we do short-term trading, and using higher time frame analysis and institutional momentum studies. And it's simply the 1840 moving average and the angle and separation based on those two, and that in combination with market structure concepts and market flow, using swing highs and swing lows, and introducing the Judas swing, and or looking for bullish SMTs or bearish SMTs based on that buy or sell program, based on where we're at with the moving averages. If the 18 period is above the 40, we're in a buy program. If the 18 period is below the 40, we're in a sell program. Only if we have angle and separation and market structure broken to support that. And then you just wait for the fractal to form, get yourself in sync, wait for your buy zones on your pivots for buy days, and look for opportunity areas to get oversold, and look for S&T divergence and optimal trade entries, and combine all those things. And if you get a confluence of at least 3 things supporting your trade, go with it.